Can I fund a whole life insurance policy with a one-time lump sum? The answer is yes, but it doesn't always make sense. Today, I'll go over why people want to do that, what it looks like, and then what I would do in order to fund a policy with a lump sum of money to get as much cash value as possible. So let's start with why people want to do this. It's always because someone is interested in the cash value, and they're interested in the three core benefits: being a safe place to put money that they can access anytime, and it's also tax-free as long as we follow IRS rules. Now, why they're attracted to the idea of a lump sum payment is usually because they have money in the bank or another account. They like the benefits that come with cash value, but they do not like the idea of having to make ongoing payments, which I totally get. So let's pretend that this guy's you. You've got a $1 million lump sum and you want to move it into a whole life insurance policy, and the primary goal is to get as much cash value as possible, both short-term and long-term. So that $1 million can go toward the base premium, the PUA rider, or the term insurance rider. Now, the main objective here, when you're using a lump sum of money, is to get as much money as possible into the PUA rider. The reason why is because this immediately shows up in cash value. It's critical when we're funding policies with a lump sum. I remember years ago, when I first got into the business, my dad asked me, can I just put everything into that PUA rider? And the answer is no, because there are insurance company limits, and there's also IRS limits that we have to follow. The IRS limit is the MEC limit on a life insurance policy. So the benefits of the cash value are what? Safe, liquid, tax-free. Any life insurance policy can become classified as a modified endowment contract, and if it does, we've got to deal with tax issues on the cash value. It strips the policy of many benefits that come with you being able to access the cash value. So we don't want that to occur. So of these three areas where we can put money, we want to reduce the base premium and we want to add a term insurance rider. The reason why it doesn't build any cash value, but it does get you a lot of death benefit for a very low cost, which drives your MEC limit. So let me go through the rules of the game right now, because a lot of people do want to understand how this works. So with a life insurance policy, the MEC limit is an IRS limit, and this determines the maximum dollar amount that you can pay into your policy per year. You'll find that the MEC limit on your policy has a direct relationship to the death benefit. The base premium drives the death benefit, which ultimately drives the MEC limit. Also, the term insurance rider drives the death benefit, which also drives the MEC limit. So those two areas are very important. Now, another name for the MEC test is called our 7-pay test. When I'm funding a policy with a lump sum, this has to do with the first 7 years of the life insurance policy, and specifically the death benefit. So how the 7-pay test works is that death benefit on your policy, whatever it is day one, I can't reduce it during the first 7 years. And that's important to note because the base premium and the term insurance rider are still due through the 7th year. So what this means is if I fund a policy with a one-time lump sum and then I never pay anything else in, I'm using my dividends and interest on the policy to support that premium cost for me, the base premium and the term rider premium. And I'll refer to this as drag on the policy. It's going to slow down the growth. Now, at the 8th policy year, I have the option to exercise what is called a reduced paid up, also known as an RPU. You can do this anytime you want. However, if you do it before the 8th year, you'll trigger a MEC, that taxable event. So we don't want that to happen. So I do want to look to use that reduced paid up option, but in the 8th year, in order to eliminate the base premium and term insurance rider or cut the drag. That's the name of the game. So let's take a look. We'll start by looking at a one-time lump sum payment. We're going to look at a policy for a 60-year-old individual, and we're going to look at guardian illustrations, and these are all the exact same product for the exact same individual. So here we've got our 60-year-old with $1 million. He throws it into the policy. So walking through line 1, his base premium plus term insurance rider came out to about $47,000. He paid in a total of $1 million, so the other $953,000 went toward PUAs. There's his net out of pocket of $1 million, and his first year cash value is about $940,000. That's 94% in the first year, very attractive. His death benefit is very high at $12.1 million. The main reason why is because this gives him a MEC limit of, guess what? $1 million in order to accommodate that first year deposit without triggering a modified endowment contract. Now, what happens beginning the second year? He pays 0, but to the left, you see this premium and term rider, and the cost is going up. The reason why is because we have 2 term riders. One of them is massive, and the premium increases every year. So the costs are going up, which whenever I see that, what I want to see is how is it impacting my cash value? And initially, his cash value is going up with 0 out of pocket. But then it slows down and eventually comes backwards. So you were trying to get your plane off the runway, but you just had too much weight and you couldn't do it. Now, in year 8, we exercise that reduced paid up option, which results in the death benefit coming down, and then your cash value really starts to pick up the pace because we've cut the premium. So now your dividends and interest don't need to support that premium for you. See what's going on here? Fun stuff, isn't it? So you can fund a policy with a lump sum, but it doesn't look all that good. Let's look at another example. So here's spreading the payments out and having no drag. So when we look at the breakdown of the money, here's your base premium and term insurance rider, $11,000. Here's your PUA rider, $89,000. Add them all up, $100K per year. First year cash value, 87%. That's still strong. Break even point, year 4. Much better than the last example, which was year 8. Now, we exercised that reduced paid up option in year 11. The earliest we can do it without triggering a MEC is year 8, but it doesn't have to be that early. It can be later if we want. So here, we did it in year 11, but because we've been funding the policy aggressively for 10 consecutive years, there's not much of a drop in the death benefit. A lot of people like this option. And there's no drag either because we covered the premium costs every single year. If we look at this, say by age 80, the first example, you're at 1.8 million, but this example, you're at almost 1.9 million. So you've generated almost another $100,000 by spreading the payments out, which is interesting because with almost any other asset, if I put all of my money in up front and that begins to compound, I'm going to have more money long term. Not the case with insurance though, because I also have the cost of life insurance and I've got those IRS rules I have to follow. But here's what I would do. Here's the sweet spot right here. Spreading it over 4 years, which is interesting because I do have some drag with this policy. So looking at this example, the premium plus the term rider cost, $25K, $225 going toward my PUA for a total of $250. First year cash value, about $220. Death benefit, just over $3 million, which gives me a MEC limit of, guess what? $250,000. I'm cash positive by the 4th year, which is great. And then years 5, 6, and 7, I still have this premium due. I'm not paying it. The policy is covering it with the dividends and interest. However, if we look at this guy at age 80, look at your cash value. You're at $2.1 million. That's almost 200K more than the example we just looked at, which spread the funding out over 10 years. So even with the drag, we're moving a lot faster. So the reason why is because we got money in fast enough where the compounding easily exceeded the costs. How I like to explain this is we got off the runway and that plane can easily carry that weight now. And then eventually, we still cut the drag with that reduced paid up option. And then the cash value grows even faster. Some people ask, well, can I just pay that premium? The answer is yes, and you'd see it show up in cash value, so you'd see even a little bit more value as a result. But to get back to the question, can I fund a policy with a one-time lump sum? Yes, you absolutely can. However, an initial lump sum all up front doesn't make the most sense in the majority of cases. It often makes the most sense to spread that out. Your age does matter. The older I am, the more sense it makes to spread it out over a longer number of years. 60-year-old, typically 4 years is the sweet spot, depending on their health too. If I'm 50 years old, 3 years is going to look better. But typically, it's just looking at the different numbers. And if you're in a situation where you said, well, I don't want money just sitting in my account, because we do hear that, then what you could do as an alternative is see if the insurance company you're working with has what is called a premium deposit account, also referred to as a prepaid account, where you can park premium payments for future years. It earns an interest rate between 5 and 5.5% with most companies and feeds the policy for the number of years you specify. It's a nice option to be aware of. Not everyone likes those though, because it does tie your money up for some time. Anyway, I hope you enjoyed this video. I would love to hear your thoughts in the comments below. And as always, I hope this helps.